back to Mortgage Mondays. I'm Julia, this is Daniel, and today we're going to talk about private mortgage investments with a specific topic in mind. And what is that topic, Daniel?
The topic is risk.
Risk, that's a good one.
Yeah, I got asked this in the meeting the other day, where is the risk for the investor?
Yep, okay, cool. Well, let's start with number one, because we have three.
We do have three. It's not meant to be the entire amount of risks that we're covering here, but
you've just picked a few that you think are important.
Yeah, a few key risks that you should think about.
Excellent. Well, number one is legal risk.
Legal risk is key. You want to make sure that issues such as Contracts Review Act and making sure that the loan that you do is not for consumer purposes or coded. They're the two major risks, and making sure also that you've got getting good title over the security that you're lending against.
Okay, cool.
So there's some of the risks. There could be some more legal risks in there, but we'll talk about that a little bit later.
Cool, moving on. Let's do number two, which is security.
Security is the asset that you've loaned the money against. Now, this is where a lot of investors fall down. They lend the money against the property, for example, and when the deal goes bad and they go to collect out, that asset or that property is not worth anything or anywhere near the value they thought it was worth before they did the deal. So you've got to make sure that when you lend the money, that the property, you've satisfied yourself. A lot of people rely on valuers, which is a great guide, as we've talked about before.
Yep.
But the reality is the buck stops with you as the investor. You want to make sure you've done your own research to make sure that that property is worth what you think it's worth.
Okay.
Or at least is in that ballpark.
Okay.
Because when you go to collect out on a property, your legal fees and your interest costs and liquidation costs, they all add up. So you need that buffer in the property value.
Okay. And number three, the Black Swan.
The Black Swan, what do I mean by this?
What do you mean?
Well, the Black Swan is just something that we haven't covered or you haven't thought about. Now, when you do a deal or when you lend some money, things come out of the woodwork that you'd never expect. That might be 1 in a million chance or 1 in a 100 chance. So you need to make sure you cover off that risk when you lend the money or you invest your capital.
Okay.
And you want to know how the best way to do that is?
Please tell.
It is spread. So you want to make, sorry, I just want to make sure I have my microphone on. You want to spread your risk out because sometimes things can happen or go wrong that you never thought.
Yeah.
So a good guide which they use, which I try to get people to work by is a 10% rule. That's just my personal opinion. I mean, it might be wrong, it might be wrong. People might have a 5% rule. And what I mean by that is don't expose any more than 10% of your investable capital, not your net worth as an investor, of your investable capital in any one transaction or deal.
Okay.
So if you're worth $10 million, but you're only investing with 100 grand, don't put any more than 10 grand of your eggs in one basket.
Okay. Okay,
and that's pretty much it.
All right, cool. Well, if you've got any more questions or you'd like an appointment with Daniel, call the office on the 1300 number. Thanks for watching.
Thanks for watching.